Stephanie, some unprecedented activity here. The IMF weighing in on Fed policy for the first time in my memory. I could have it wrong, but I've never seen anything like this before.
I have not. Lisa Abramowicz is here. Joe Weisenthal has joined us. We're all sort of, I'm gonna kill you, all eyes on Christine Lagarde. But from all the traders I'm speaking to in the market, honestly, this shows just how fragile the underpinnings of this QE-based global economy are. I mean, the fact that Christine Lagarde is coming out and saying something like this and factor in liquidity, volumes are down 70% in U.S. Treasuries since 2007. This is a whole new world. The fact that she's coming out waving a flag like this is concerning, no?
Please don't stop the morphine drip, please.
But that's it. Does she just not want, she just want to put a big Band-Aid on this because she can't face a disaster on her watch?
Well, the IMF has been particularly worried about bond funds. They've come out with a lot of papers about, what will happen if people just start pulling their money, particularly out of emerging markets. And she did raise concerns again about emerging markets. So if the federal government of the United States of America has a financial style, if the FSOC has a financial stability mandate, that will change their analysis of the situation and their calculation as to when to hike rates.
All right, Lisa, Joe, you want to wait? But before you do, hold on. Carl Riccadonna from Bloomberg Intelligence is here. Eric, you want to reset?
I just want to remind everybody what Madame Lagarde, Christine Lagarde, managing director of the IMF, said just moments ago, and what's really captured our attention this morning. Have a listen.
Higher U.S. policy rates could still result in significant market volatility with financial stability consequences that go well beyond the U.S. borders. In weighing these risks, we think that there is a case for waiting to raise rates until there are more tangible signs of wage or price inflation than are currently evident. So in other words, we believe that a rate hike would be better off in early 2016.
Joe is chomping at the bit. We got to let Joe Weisenthal
Carl, we'll get to you in a second.
Sure. Well, look, I think, as has been pointed out, obviously she's concerned about financial stability, she's concerned about emerging markets, but she's not saying the Fed should never raise rates, and there's a pretty solid argument that there's no rush, there's no signs of real inflation. She's only saying, a lot of people think that the first rate hike will be in September, so why not wait a few extra months? It doesn't, I think you could debate, it should be now, it should be September, it should be early beginning of next year, but it's not like a radically different proposal she's suggesting for Fed policy.
Policymakers are just praying that growth is going to get us out of this hole. But as we get more economic data, and it doesn't look like growth is going to get us out of it, it smells like they're getting panicky, no?
These are very explicit instructions from the IMF, and I think it's very unhelpful because it is trying to paint the Fed into a corner. The Fed's mandate is to steer the U.S. economy and to do what's best in the interest of growth, full employment, and price stability. To be, potentially sacrificing what's best for the U.S. economy in the interest of emerging market economies is not the Fed's mandate,
however,
so the Fed can't react to that.
Stan Fisher thinks that the Fed should take that into consideration.
Well, they can take these bigger issues into consideration, but their mandate from Congress is full employment and price stability. So they don't want to intentionally blow up. They don't want to blow up the world.
This is interference. Is this inappropriate?
This is
improper
an
interference.
Inappropriate level of interference. They were much more broad brushstroke suggestions from the IMF in the past, and now they're telling Janet Yellen, you should have a press conference after every Fed meeting. You should, we'll tell you when to raise rates. This is going too far, and I think it may, create all the more reason for the Fed to say, it's one and done. We're going in 2015.
Joe?
See you in September. Yeah, that makes a lot of sense that the Fed is just going to... I wouldn't expect the Fed to take the IMF recommendation too seriously. But on this point about being data dependent, look, the Fed has missed its inflation target for year after year after year now, and they're still below the inflation target. So this idea that why not wait until... It doesn't strike me... It doesn't strike me that the IMF suggestion is that far out of line with what they're going for.
And if being data dependent means wait till 2016, that's fine. But wait until the data tell the story, not until Christine Lagarde tells Janet Yellen what to do.
But even the U.S. has moved beyond just looking at jobless numbers in the U.S. We're also looking at inflation very closely. And inflation is not one nation. It is a global event. It is a global affair. You can't have one nation so easily detached from everywhere else in the world.
Here's the problem. The Fed has a dual mandate. part of it is employment. Employment is a concurrent economic indicator. If you're setting policy based on inflation, which is a lagging indicator by several quarters, in the U.S. it lags growth by 6 quarters, you're setting policy looking in the rearview mirror, and that's a good way to drive off a cliff. We have an emergency stance of policy in place, and with the unemployment rate potentially having a 4 as the front number in the third quarter of this year, we're going through full employment. We need to start moving off of that emergency policy rate. And one rate hike is not going to upend the boat.
Furthermore, just because the Fed has missed its own inflation targets, Joe, does that mean that instead the Fed should allow Christine Lagarde to effectively stick her finger in the air and say, this is the way the wind feels like it's blowing?
I don't think the Fed isn't going to allow anyone to tell it what to do. But, I mean, the IMF is always telling other countries what to do. So is this really that unusual?
Hold on.
In less
telling other
explicit
countries
terms.
what to do is very different.
Especially when they're creditor, countries.
There you go.
She also said something else interesting. She said there's a bigger risk of the Fed hiking too soon than hiking too late, than inflation running away. And that's actually not consensus. I mean, it's not necessarily, there's a lot of disagreement in the bond market about whether that's true. So that's just one question. As Carl was saying, you know, if inflation is a lagging indicator, it could get away from that.
I got to mention a Dodd-Frank moment for a second. I'm speaking to guys on the street who have said there has been, in the last day, even this morning, quite a big buyer, and the street simply doesn't have the balance sheet to facilitate it. If this was 2006, 2007, this is when, whether it's Bill Gross or George Soros, this is when the 10,000-pound gorillas who have that kind of conviction can come in and say, this is my view on the market, and they can't because the street has no bonds to sell them.